Welcome to another episode of The Finish Line. We have a special guest here. We have Eric Akbar. He's a director of business development from Lendfinity. Eric, we're really excited to have you here. Tell us a little bit more about you.
I've been in this industry a long time, 20 years. I started off as a financial advisor and was still doing mortgages through London Life and Manulife. And then, it was just not quite enough. Started as a mortgage agent and spent 11 years of it as a broker.
Yeah.
And always had a passion for alternative lending, doing things that, not everybody else could get done. From there, obviously got more into private lending. The last few years, spent a little bit of time even on the software side and understanding a little bit of the loan origination software and understanding what the needs of our alternate lenders was in the country. And most recently at Lendfinity, it's been a blessing to have such an awesome team and the flexibility we would have needed. It's nice to think that you can do some things. It's great to feel that you have flexibility of what fits within a box as well as things that are out of the box. So, and obviously through that, I've got to meet some of the newer up and growing teams, such as yourselves, and I wouldn't call you new, but growing, but definitely growing, and seeing what everybody's experiencing, because I think the last 5 or 6 years you've seen just about everything shift in this market. We've had incredible highs and things that you couldn't keep up with the demand, and then we've gone through some of the toughest corrections in the market, and I think knowing who can ride out the highs and the lows really starts to give the consumer a perspective of who the successful advisors are in this industry. It's nice to be transactional and say I can solve a problem, but do you have the knowledge? Do you have the vision to be able to give me the advice when things are not great?
No. So, Lendfinity has been around for how long now?
It's as an organization, it's been around since 2018. But
nice.
Obviously, it's had a couple of rebrands, and most recently with some of our new team members, we're really trying to get a big push forward. And
you guys are pushing really hard.
I mean, listen, there's some old and well established alternate lenders in Canada. And I think the need is continuing to grow. I'm starting to see more specialization. You start to see who's really suited for what type of product. We got guys that are basically a B- lender. If a home trust or an equitable bank can't be my solution, I just need a little bit more. And you get competitive rates. You get some crazy products that are just amortized, and it's a real solution.
So you guys are more in the.
We would be probably a C.
So a lot of consumers don't know what A and B and C is, right? So A is typically banks, any of the banks. B's are the alternative lendings, which is home trust, equitable, those kind of banks. And that's where you guys fall in is the C space, which is the private space.
Absolutely.
Now, you guys are some of the lenders that are still doing 80%. Is that still a thing?
That's
There's a lot of people. There's a lot of lenders out there that don't do 80%. What you think there's a risk appetite for that still? Like you think with the market shifting now, do you think you guys will still be doing 80%?
I think so. I think understanding, we're one of the few lenders that focuses very much on the exit. A lot of lenders are more focused upfront on serviceability, on the client's credit, income, and that's great. So when you look at that, you're relying on the client obviously being able to meet their obligations, and you not having to think about, how do I protect my interest in this property? But for us, we put the exit first. So if we're looking at an 80% LTV, it's because we have a great team that can really look at the valuation, understand the market direction in that property, and we need to have a closer line to that deal to understand if things are not going to go right. How do we get out? It's important. People end up, for example, doing fully prepaid loans. So when things start to falter, you don't see that till a year down the road. But if you do, say, even a 75% prepayment, where a client has like a $500 or $1,000, something that's affordable to them,
they can keep it going.
Not only are you giving them that repayment history that's going to be great wherever they go, that say, hey, I may have had issues in the past, but I've been able to meet my obligations. But if it comes down to the unfortunate situation where they can't meet those obligations, that 3 months in, where the market, maybe if it's in a declining market, hasn't declined quite as much. But generally, if we're going to look at 80% LTV, it's what's the exit? Where's it going? Maybe we're helping the client, navigate a sale in a more timely manner as opposed to, being forced into that situation. Maybe it's a situation where, the client is bankable, the deal is bankable.
Yeah.
We just need to get somebody's credit fixed. We
And
need
then
to
move
get
them over.
and then move them over. But there are situations where there is no exit.
Yeah. And what do you do for things like that then? What happens if you have something on the books where the clients cannot go anywhere and the value has tanked? What do you do?
I think that's the part where you have to communicate. Unfortunately, I've seen a lot of lenders look at it as, or not just lenders. I think it's a combination of lenders, brokers, and people who are providing that solution, looking at it as, let's just kick the can down the road. Let's just say, okay, well, we'll give you another renewal. But you have to have that conversation with the client. If we're going to do it, we say, hey, here's a 6-month extension. Let's get this property listed now.
Yeah.
I know you've been able to keep up with your payments, but there's only one direction this condo market's going. Maybe if we had a horizon of 5 or 6 or 7 years, we could look at it.
Yeah.
But by nature of the type of product we look at, it's a 1-year product, right? So if we're looking at a year down the road and we don't see a reason for this market to go up, it's either at best case stable, more likely to have another decline just because of the availability, the sheer number of units that are still coming to market. So those are the conversations where we have to get to the client and say, it's time to sell. You may get something out
and walk away with some kind of money.
With something, as opposed to we do even more renewals where there's more fees, there's more expenses.
It's just added fees for no reason.
You have nothing.
So you touched on condo market, condos. I just want to bring that. Where do you see the condo market going? I know last time we had a great conversation.
Absolutely.
And what do you think the condo market is?
I think it all comes down to the horizon. I think short term, there's still a lot more hurt left, especially if you are the type of unit that's just a dime a dozen. We're looking at some of these buildings. We'll get an appraisal, and you look at a value, but there's 30 other units available for sale in that building.
Yeah.
So
similar units.
Similar unit,
yeah.
plus or minus 100 square feet. So how do you say this unit will sell for this price? I think it'll come down to who of those 30 is the most desperate, who can't weather the market, who can't. And I think that's going to probably put some pressure on the market. But if you want to look at the longer horizon, we haven't built anything. The condo market served a very key part of that ecosystem. I remember there was days that there was $250,000 condos where you came out of university, you had a job, you put a 5% down, and you got somewhere. But that went away. I mean, to some extent, some of these price corrections have brought $350,000 condos,
which is
back
pretty
to the
decent.
market. But if we're not continuing to build, let's just say this inventory in the market gets eventually absorbed.
Yeah.
Whether it's by nature of people who get forced to have to sell at cheaper prices, or entities that may come up, we'll see them already in this space. Yeah, exactly. They start to look at it as, if we can get them cheap enough, we're going to buy it. And now you're no longer going to have that natural progression of a homeowner that says, I buy a condo, I sell it after so many years, and we're not building new ones. A lot of these people are just holding it as a rental property. So what do we get? We get a rubber band effect. On the other side of it, now we got, hey, there's 3 or 4 years, maybe 5 years, where we're not going to get proper new condos coming to the market. So now the resale market in the condos starts to go back up. Now, is that something to go count on and go buy all these condos? No. But it does change the horizon for the person who bought the condo for the purposes of living in it.
Yeah.
I'm happy with the mortgage payment that I have to meet. I'm happy to live here for the next 5 years. I'm not looking at it as just an investment tool.
Yeah.
So that horizon lets them ride that out, and hopefully on the other side, when the time comes for them to say, I'm going to sell this condo, I'm going to upgrade to a house, or I'm going to
made some money on it.
They've at least not gotten burned.
Yeah.
But people who looked at a lot of these, speculative purchases, people who said, I'm going to, instead of buying one property with, a decent down payment, I'm going to go buy 3 or 4 condos. Yeah. I think those are unfortunately going to get burned.
Getting burned. I had an appraisal yesterday on a condo that's closing. I think it's already an extension, and they bought it for 1.1. I believe it's a 3-bedroom or 2+ den. The value came at $650.
Yeah.
And that's about a $450,000 drop, if not a little bit more. And I don't even think it's the client has the money to close on it, or it's the right thing to close on it. So hopefully the builder's gonna work with the clients and see if they can give them some kind of price reduction, because that price is huge drop. Now I know we talked about this before too. There's some banks out there still doing blanket appraisals. Do you want to talk about a little bit more on blanket appraisals?
I think a lot of people have looked at it and unfortunately don't look at it in the right lens. They frown upon the banks doing it. They're like, this is just the way of the banks, kind of trying to steal business.
Are they really stealing business?
No, I think when you think about it, if I'm a major bank that's financed the construction and I'm owed, $300-400 million in construction in this property, I have one of two choices. I either find a way to get this from a construction stage to basically a completed project, the construction loan is paid back, or I'm going to have to basically push the builder and say, well, you couldn't close the units, or this is what's happening, you're on the hook.
Yeah.
But ultimately, a builder is a corporate entity. In Canada, we have lots of mechanisms for them to take proper restructuring steps, where the people who make those decisions will continue and will go on to have other projects. But that project will eventually become insolvent. It'll either go to receivership or some sort of restructuring.
Yeah.
And the banks will get burned to some extent.
Yeah.
Ultimately, a lot of purchasers will obviously pay the price too, because if the property can't close properly, we'll have those challenges. Or the bank can say, if I do this blanket appraisal, the vast majority of the people that bought these units didn't buy them to flip them.
Yeah.
50-60% of these people were happy. When they saw what price they were paying, they knew what the mortgage was going to be. They're happy to pay that mortgage price and live in this condo for the next 5 years.
Yeah.
Potentially passing this phase that we're in. And those are the clients you're not going to have an issue. And then you're going to have probably another, 20-25% of these people that'll say, oh my God, if I don't meet my financial obligations, my credit is toast. I'm going to have to claim bankruptcy. So one way or another, even though this property is now worth maybe less than what my mortgage is, I'm going to continue to make these payments because I just can't risk my credit. I don't want to be, starting from scratch with basically no credit, or potentially losing my other assets if they've got other investments, other properties. Then you're going to have a part of the market that is that, speculative purchaser. That is those guys. And, if that portion becomes your delinquent part of your book and you're going to have to go take a haircut, I mean, listen, they had some deposits, so the equity isn't completely depleted. But even maybe there's going to be an entity in receivership that comes and says, I'm going to buy a bunch of these. Mm-hmm. So the blow is going to be a lot less. And ultimately, it gives the market the step forward. Because remember, banks, as much as we say they're giving you a mortgage, what's the biggest part of that covenant they look at? It's your ability to service that loan. So, there's banks that are handing out unsecured credit at $100,000, $200,000 because they have enough comfort with that individual that they know they're going to make that payment. Mm-hmm. A mortgage is a little bit larger, so they want a little bit more security. But ultimately, when they say, if it is your owner occupied, if it is something that you're going to live in, chances are you're going to make that payment. Because the alternative is what? Go rent?
Yeah.
Maybe
rent is almost the same as sometimes owning, right?
So as long as I know that they have the ability to make that payments on that mortgage, then I have a secure loan. Mm-hmm. Now, yes, some people will say in the perspective of an investor looking at it, because the banks are going to take these mortgages. They're going to put them in other vehicles. There is going to be other financial instruments that are relying on them. But again, most of those have a horizon to be able to handle some of these changes in the market. And again, I think we were hearing in the news that even the province is now stepping in and trying to fund other entities that are going to come and buy this inventory of condos. I don't know if that's the greatest solution.
Yeah, to turn it into purpose-built, to
almost like rental pools. Bad decisions were made on multiple parties. Yeah, whether it was the builders that built and sold properties that couldn't be built where they built them because whether it was cost of land or cost of construction, people who bought condos that they probably couldn't afford, and ultimately institutions that got involved. I think there is a healthy bit of that hurt that needs to pass through the system so that we don't do the same thing again.
Yeah. Now, we talked about this earlier too. There's builders also being bought out as well by other builders, so they go into insolvency. So how does that affect the whole condo market as well? Is it just does that mean the consumer gets their deposit back, or has the option of going back and claiming the deposit and restarting, or do they just assume it?
We have pretty good laws around projects. If the project hasn't been started, obviously, if it's in the right stages, basically the deal is being turned over. You get your deposit back. You do actually get the interest for the period that it was sitting there. It's minimal.
Yeah.
Because they keep them in. But that's going to be a lot of them. We're going to get a lot of people that are looking at, cost of construction. I was at a builder function just before the holidays, and they're talking about it costs $1,000 a square feet in the city of Toronto to build a condo, not accounting for the cost of land. Over 30% of that is taxes, levies, charges. So when you start to think about those numbers, a lot of them are going to be like, it's not the right time.
It's not worth it.
It's not worth it. Will that change? Will the cost come down? I think so. I think the government has already tried to take some steps on their side. But even the actual cost of construction itself, I think, ballooned because of the demand that was out there. You would go out there and you would bid on these projects knowing that, there's more cranes. Yeah. There was a point where there was more
cranes, a lot of cranes in the skies.
So somebody's got to get these done.
Yeah.
But I think some of these smaller builders getting bought out also changes the environment. I remember the days it was only a handful of big builders.
Now everyone is a builder now, right?
Everybody's trying to build them. Yes, there is something to be said about experience and the ability to get these projects through because we see them. Even today in this market, it's the bigger builders that have been able to weather
They're
some
sustained
of these
it, right?
I'm seeing smaller condos. There was a project we saw, client had self-financed this boutique condo. So no bank financing at the time. So they hadn't gone through the steps of getting pre-approvals and things like, hey, come here, we'll sell you the unit.
Yeah.
But they're selling, $1.9 million penthouse units that are 1,300 square feet. And now that thing is getting appraised low 800s. I mean, we're talking about the millions on there. So how can this project now it's no longer ever in the question whether the client can close. We're at a situation where the project can completely fail because the unit is built. It's going to come down to eventually somebody having to take over the project where, the builder's wiped out. You hope as an owner that at least the right structure within the condo corporation is going to protect you so that, if you're in a condo where, 50, 60% of the units aren't occupied, well, how is the cost of that occupancy?
Correct.
Exactly. How are those common element costs being absorbed and handled?
So if it's vacant, does that mean there's no common element being charged on it?
No, it's being
it's
charged
still split.
Somebody's owning that unit.
Yeah.
It's not
so it's going to be passed on after.
Somebody, yeah.
Oh, wow.
So whoever is sitting on that unit as a condo corporation is going to have to, you have an obligation to that corporation. Wow. Now, whether it's the builder holding it, whether it's a third party company holding it. But yeah, these are the problems that are coming out with these units that are ghost units, right? Nobody wants to buy them. They're valued at a point where the builder's got no choice. And that's what you've seen. You've seen some builders are stepping up doing VTBs. It's saying, hey.
Hopefully they'll start doing more VTBs because I think the appraisals are still going to come in. What do you think? You think it's going to get a little bit better, or you think it kind of stabilized now, or you think there's chances that it can drop a little bit more?
I'm still seeing a bit of a decline.
Yeah.
Because there's two facets to that. One, there's still inventory coming out. There's still a lot of projects that have closed, especially like Mississauga, Brampton. There's big towers that have closed with units that people are now getting to the point where it's like, I cannot close. I'm going to walk away from it. So whether it's builder inventory coming or something that's going to come to market, there's going to be pressure.
Yeah.
But I think there's also going to be some pressure from enforcement from last year. We're in a system in Ontario where it takes time for you to take possession.
Yeah.
So somebody who, defaulted on a mortgage last year, that lender has got this unit now coming to market. So there is going to be more pressure. Yeah. But I think it also depends on where that condo is.
Yeah.
I'm seeing some condo markets that are back to, I would call it stable. There is a healthy balance of inventory and
certain parts
and demand. Yeah. I see more of that downtown Toronto now.
I think downtown Toronto will always kind of be a good hub to. Can't go wrong with downtown. Like, you know what I mean? I always thought like
things that are along the subway line, I've seen them stabilize, a little bit more. They are coming in lower. But as you said, like if you're looking at one that's coming 30, 40% lower, those are maybe coming down, 15, 20%. And I think that's more manageable by all parties.
100%.
But I think in the resale market, I'm starting to see, units that are still moving. They're coming to market. They're moving because they're different than what's everybody else. So if you're a one bedroom in Mississauga,
just like any other shoe boxes,
and you've seen the condo square footage on some of these things.
Yeah,
and I was seeing 480 square foot.
What's the minimum you guys do? Or is
I
there a
don't think
minimum?
I don't think we draw it so much as a square footage, but we'd like to see a bedroom. I think
Bedroom,
studios,
self-contained unit at least,
yeah,
not like
yeah.
one of those studios, right?
Studios are
And is
tough.
parking necessary?
No,
No?
not
Okay.
on a one bedroom. But if you start having to tell me you have a 2 bedroom or a 3 bedroom,
Yeah.
you don't have a unit, it's not to say that we won't do it, but
Yeah.
I know I need to have a more conservative approach on that unit because it's just going to be more difficult to sell it.
When I bought condos downtown, parking was $120,000
Yeah.
in some of those. Just a parking, like, you know what I mean? Now, and you have to pay maintenance on the
business. Yeah.
parking, which is crazy, you know? You're paying rent on that. So yeah, things have changed a lot. Hopefully those prices will come down and more consumers will be able to jump into that. What are you forecasting with things that's happening in the Middle East right now? You think it has an effect on the way the market is going to be shifting, the rates? I've seen like a lot of the lenders have already started, banks are always,
Well, it's the bond market.
Yeah.
There's two aspects that I always tell everybody to look at. If we wanted to just look at the fundamentals in Canadian, it's called Ontario real estate, we actually haven't been in a bad spot. I saw some of the great work that some of the team had done at the LCG show, and if you bought a house at the peak of it when everybody was running to market with the low interest rates but at the higher prices, and you look at what the actual monthly payment you were paying is versus today with the lower price but a higher mortgage payment, your
almost
affordability is there.
Yeah.
You got more inventory, so realistically there should be more movement. But I think
consumer confidence.
Gotta love our news, right? They know how
The
to
media.
they know how to harp on terrible after terrible.
Yeah.
Even some industry news, like I'm not gonna name them, but I look at some of our good sources of mortgage news, and I look at every day, every piece that they're putting out. Listen, I know there is a tough market. I know this. Do you want to expand that narrative, or do you want to talk about what does it look like after this?
Yes.
So sure, we have conflict in the Middle East that's definitely affecting the bond market, like anything else.
Just like
oil prices move, everything moves. The bond markets are going to move, so the fixed rates are going to move with that. But instead of getting everybody, in this mindset and mentality that the world's falling apart and the sky is falling and the rates are going up. Our variable rates are still an option. It's not for everybody. The thing that you start to see with everybody is that they see it as a finite thing. Even a fixed rate mortgage, that's a high rate mortgage. It's not the end of the world. I think a lot of people forget what a little bit of that rate change actually does in the grand scheme of things.
With the payments, right?
In the payments, exactly. And what does that payment mean today against the overall income of that individual, right? Yeah. Yes, if you're an individual who's absolutely maxed out, borrowing to the limits of your income, it's going to have an impact. That's a problem. And, that rate movement, the way we're qualifying people today with some of these.
We already have the stress test in there. Anyway.
Exactly.
2%.
So if you're qualifying at that, then that's what you should have a comfort zone with.
Yeah.
Not what your mortgage payment is. Your mortgage payment is a bonus.
Yeah.
And in fact, I remember one of the old mortgage brokers I used to work with, he said, I used to educate my clients that if you are looking at a stress test, make that your mortgage payment.
So when it goes up.
You don't feel it.
Yeah.
Pay your mortgage down faster. Instead of trying to go buy something bigger, instead of trying to do something that's like, I know that's the maximum stress test, but I can make myself house poor, spend money on nothing else, and just buy a little bit more. But that's not always the best route you have. I mean, yes, there was a time in that our real estate market was a phenomenal investment tool. Changes in the market proof that you want to be diversified.
Yeah.
You want to have a healthy saving portfolio. Think about it today. If people that had bought these condos had healthy savings,
they can sustain it for a bit.
They can sustain it for a bit.
I think there was a lot of people that were speculating as well on the condo, right? Like, hey, let's bank on the pre-cons, put some money aside, it's going to make some money, then we'll cash it out, or even do assignment sales, right? I think a lot of people that I've been seeing as well, even some realtors sometimes, they got burned with assignment sales. They got into these markets, they thought they can get ahead by buying a few of these condos and then flipping it. But you know what? They just got caught on it. We've been bailing out a lot of people. And I don't know how worse or if it's going to get better, but I just hope somehow we see the light at the tunnel.
I think there's a big gap in real estate investment. If today you came to a fund, you wanted to invest in a MIC, you wanted to invest in a mutual fund, if you look at the level of qualification the individual that's talking to you needs to have, whether it's CSC, whether they're going to have courses, the level of KYC they have to do to understand your needs, do a needs assessment, risk profile before they can sell you at $20,000, at $10,000. We lived in an environment where a realtor, and I'm not saying this that pointing out that they're at fault, but there were some bad apples. You never went through any suitability study.
Yeah.
You didn't have to go through this. You said, I had a client that said, hey, I've got $1 million and I want to make some real estate investments. We
What's
can buy
the
a couple houses. Let's go buy 15, 20 of these units. We'll get assignment clauses. We'll get low deposits. And they were selling this as an investment vehicle. They were selling this as a strategy without the knowledge of what's that client's risk appetite, how much of their assets are being invested in this. If that $1 million is all they have, you should never be doing this with them. But they did it. And at the end of the day, the borrower has some responsibility, has some, nobody forces you to do it, but bad advice.
But clients also have the choices as well. Like they
100%.
have the risk tolerance, like they know their risk tolerance as well, that they can make.
But
those
we don't
choices.
ask them.
That's one of the things.
That's the point. If you went to go buy a rental condo, nobody
asks you what your horizon is.
Does this meet? No, as long as you could show up with a pre-approval,
you're good.
You're good. No, we did not have the gates to be able to distinguish a person who was buying a condo.
Yeah.
Because if we had only sold condos for owner occupied and say maybe an individual that just had one rental, I don't think we would have had the demand for the condo market that we had today. And B, I don't think we would be in this situation because we wouldn't have somebody that had bought 6, 10, 20 units. We still see clients that come to us that have healthy profiles.
Yeah.
They have 15, 20 properties. We no longer have a system for them to finance those properly.
Yeah.
Because all the A lenders have eventually said,
capped out
you're,
at
you're,
10.
you're no longer an individual risk. You're a commercial risk.
Correct.
We need to look at this as a commercial portfolio, and some meet that, and that's fantastic. Be that.
Yeah.
Your leverage is going to be lower because they need the comfort zone. You need to be able to cash flow, and your risk is more diversified. But somebody who had no business being in that, that's the individual who lost their life savings. They lost their inheritance. They lost, they had a house. They sold it thinking that they were going to, take a step forward, and 5 years forward, the money's gone. So I think there needs to be some changes probably on
KYC.
I think on the side of buying investment properties. I think we need a little bit more oversight there.
Because when I used to work at the banks, when I used to sell a mutual fund, so much questions,
Exactly.
the KYC or risk horizon.
And it didn't matter if
all
they were
these
putting
stuff.
$10,000.
It doesn't matter, or even
million.
if it's 1,000, it doesn't matter, right? But you're right. There should be something there. Maybe they will implement them one of these days.
We do it. We have to do suitability for the borrower.
borrower.
But we're not doing it at the first gate, which is are you the person? Are you able to buy this property?
Yes.
Are you? Is this within your risk tolerance?
I think we started implementing that last year and the year before. I think we, even as a brokerage, that we need to ask these questions. What the time horizon and what they're investing it in, and how much money they're investing. So that's very important. We talked about the war and we talked about the appraisals, I think, right? Is there anything else that you wanted to add on this?
As we go through these turbulent times, not enough attention is paid to who's helping these clients. I've seen the two approaches of some brokerages that have become, printing machines, right? If I get 100 applications in, I put X in, and they say, and then you see teams that are really taking that extra time. People who are getting to know the client and trying to give them solutions. And we see it on our side. I see files that come to us that are just basically, here's an appraisal here, or here's an address, and
what's the max you can do?
I'm like, and then I see guys that'll send you a write-up and they're telling you where everything is. I've lost count of how many times I've seen the same deal come first through that,
Sometimes
AB
we
gate,
talk,
and I just say, it's like,
you've seen the deal.
You're out, you're gone. And then I see the next person come back and say, and it starts by, I know you've seen this,
but
let me tell you how I
to you.
think I can do this. And you start looking, it's like, oh, there is another property.
Yes.
Oh, there is, their BCAM was low, but they have somebody that can step on and give you the little bit of credit that you need that creates that exit. Maybe their credit's not going to be fixed in a year, but this person's credit is good enough so we can take them to a B lender. It's starting to see people wanting to do that a little bit more. And I think the more turbulent the market becomes, the faster some of those fly-by-night type individuals just, fall out because they can't have success because they can't. In a rising market, you know what?
Things
you throw enough to the wall, something will stick. But
in today's
I think
market,
in this market, we're starting to see really the good people in the industry shine. The good lenders. You'll start to see lenders. I say sometimes a good decline is more valuable than an approval. Because if you don't have it in you to say, this is not good for the client,
Yeah.
It's not just me. This is not good for the client. You know, we're not putting them in anything better. And hold your team, hold your partners to that accountability, because I'm not saying that they had bad motivation, but maybe they just didn't see it. And somebody needed to be like, so what after this? If you only have one option out of this and that option falls apart, and if that's not going to work.
I think that's the main thing. Exit is really important, because sometimes, you know, certain brokers only see it as hey, it's a commission. Let me just get this deal done. But what happens after, right? Because the exit is really important. You guys deal with second mortgages, first mortgages. What's some of your toughest deal? Like, I know we talked about one of those big deals, and I came to you, I think, at the party, and I was like, hey, I have this huge deal up north. And you're like, that property, I've seen it like 5 times. But what is one of your toughest deal that you have done?
You know, the deals that we do that are tough, that I think a lot of people may shy away from, is when a good deal's gone bad. The client had all the right pieces. The property was the right property. The wrong person touched it. You know, they put them with a lender that wasn't going to renew. It's hit at the end. You know, they never missed the payment. Lender just didn't renew. Now the client's sitting in enforcement. You know, they've tried to do the right things, but they just couldn't. And then, you know, you look at that and you're like, okay, you still have the right equity. We can still get you, you know, healed and out of that. But I think the ones that are becoming tougher and tougher to do, these larger estate properties.
Nobody really. Who's the end user on those after to buy?
I'm not worried about the guy who built their own property and, you know, is now desperate to see, okay, do we need to get a B lender in first, and maybe I need a second or something to kind of bridge me until I can, you know, move to a better lending solution.
Yeah.
My concern is the person who built that, you know, $10 million property on spec.
Yes.
I don't know who's going to buy this.
Yeah.
I don't know who's going to live in this. I just built it hoping that, you know, somebody's going to come out there and buy this.
And if somebody's going to spend $10 million, they'll probably want to build it themselves. Sure. Or like, you know what, they have their own creativity, their own design. Maybe they want the bigger pool, or maybe they want the better landscaping, right? So when you start building that kind of property, you really got to know who the end user is. And again, at 10 million, not every, the pool of buyers really goes down as well, right?
Geographically for us, we have, you know, population requirements, this and that. But I say the easiest way to find out if a deal is an easy deal or not is open house Sigma. Take a 90-day look around that neighborhood. If you see no sales, or you see one house sold in this massive pocket in the last 90 days, that means, you know, you can have a great property, but you're going to be sitting on it. And that just makes me have to be more conservative. And then sometimes you go out to these pockets that are, you know, outside of Toronto, but you see, like, you're looking at that and it's like tons of movement. Why? Because prices are reasonable. They're subdivision type homes. They're affordable. Things are moving. They're feeder towns into you know, other major towns.
What are some of those pockets?
We see a lot in the East End. We see a lot. You know, you go up. You could look at Alliston, right? You know, Honda plant. You know, you go up to even Barrie. You know, we go up to 80% in Barrie.
Oh wow!
Because, you know, we look at it. You know, they've got a healthy job pool. You know, there's a hospital up there. There's a hospital in Newmarket that still feeds. So when I start to see towns like that it's significantly cheaper than GTA extended, but it's still well within that driving distance, or you got a GO train to come from there. You're going to start to see that the growth. And a lot of people who maybe are ending up in that hot water where they couldn't afford their Richmond Hill property or their Newmarket property, and they're going to sell, they're going to be left with a smaller down payment. Where do you think they're going to go? They're just going to go a little bit further up. So we look at those type of markets, and there's, you know, typically newer homes as you go into some of these newer subdivisions. Look at Bradford, right?
Bradford is also booming,
So when we look at those areas, again, anything that's got good movement is an easier deal. I'm starting to see a lot of these large mortgages, because I think when you start to think about how long do I have to accrue interest or service a first if you're in second position, I think those are the ones that are starting to get everybody a little bit more conservative.
So when a client misses payments, how long do they have? Like, how long do you guys, what's your process normally when a client misses payments? Do you guys start like enforce?
We have a system. We have a certain loan servicing system. So as soon as those NSFs come back, immediately an email's going out to the client. Often we'll sending a little ping to the broker and say, hey, you know, the client missed the payment. As long as people are communicating, you see a path forward. I say if somebody
dodging it is the worst.
That's the worst. You know, you call and you say, I need X amount of time to make this payment, and we're talking, and you say, okay, I can make this payment, and then I'll do this double up payment. As long as everybody is in communication, then we see a path forward, or your explanation makes sense. You know, this happened, now I'm getting this is where the money's coming, or I've sold this here, I can show you proof that I'm going to have money and I can pay this back. But then you get somebody that's like ghost. That That's the first
Those
time.
are the ones you come in harder, right? You got to
I
put
can't
more
tell,
effort.
but I can't tell if they're just ghosting you till they make the payment, or we're
they're
just
completely
headed for full
ghosting.
enforcement and we're going to be riding this for the next year.
Wow.
It's important to act fast because at the end of the day, we have to protect our investors.
Yes.
It's being on the lending side and the borrowing side, you have to find that fine balance. And I tell
between
everybody,
both.
If I have an unhappy investor, that's a much bigger
Bigger
problem,
problem.
because somebody who's looking at it and say, what, the risk isn't worth it anymore.
Mm-hmm.
There's much safer modes of investment for me that I don't have to be worried about.
Yeah.
And stuff. So I mean, if they're in our fund, they're very protected. But a lot of the deals that we do that a lot of people can't do is because we have true and tested investors who says it may not fit in a fund, but I'll take on the risk, and we're the administrator and we're handling it. But at the end of the day, they're absorbing a lot more risk than, say, being in a diversified pool of mortgages.
Mm-hmm.
So, and those pools are more conservative. They have a lot tighter requirements. So they're not going to be there for the person who's got a very low beacon. They're not going to be there for somebody who needs that stretch on the LTV because they just couldn't sell a property in time, or it's a condo that the appraisals came in time. So we try to make sure that we protect them as best as we can. But I've always said it's about communication. If you're going to miss a payment,
just let them know.
Let them know ahead of time.
Yeah.
It's a much easier conversation where you say, I have a payment coming up in a week.
Yeah.
I can't meet this obligation. This is what I'm going to try to do. And those are the people who you will have, not just, I guess, there's obviously the objective side of wanting to have flexibility, but there's the subjective side where you feel for them. You understand the situation. And as a person, you try to help them.
You try to help them. Yeah. But is there ever a time where the renewal is not honored? Like, is it true that if they make the payments on time, by default, they have to get a renewal?
No.
So a lender can say anytime, hey, listen, we're not going to renew this anymore. We want our money back.
I don't try to scare people. Any mortgage can be called at any time.
Even the bank mortgages?
Anything.
Yes.
A mortgage is an instrument that can be called. And it can be called for different reasons. Default, non-default. There's a lot of different things. Yeah. And depending on why it's being terminated, it has different provisions. But a renewal, ultimately, especially in the private space, if you're making a commitment to something at a point in time, you're assessing that risk
at that time.
When it comes up for the renewal, by nature, those elements have changed. Now, when we were in an inclining market, I would tell you everybody wanted to renew the mortgage. Why would I want to shake it? I want to keep my money deployed. But I'd be hard pressed for anybody that has a mortgage that they wrote last year that's coming up for renewal today that says the property is worth at least the same as it was. Yeah. Now, if you were doing a 60-65% LTV deal, no problem. There's a pretty good chance you're going to get a renewal. Nobody's worried.
Yeah.
You wrote an 80% deal last year. You're sitting much higher than that.
Yeah.
And that's where, again, if you've had good repayment, if you've had this, maybe there is that conversation of, no, we're not giving you a whole year to renew, but let's try to get the property sold. Yeah. Let's get a 6-month renewal. Let's do something. Versus you've been delinquent. You've missed 4 payments last year.
You're going straight to exit.
We're giving you a 90-day notice. We're telling you 90 days before that's coming up for renewal that, hey, this is coming up for renewal. Let's have a chat. And that chat is, you're not going to be in a situation where you're going to have a renewal. But if you are in the right situation and we are getting that 90-day head start, then maybe we're working together and you're getting out of that. But no, there is no such thing as a guaranteed renewal. There are some loans. Let me not put it that way. There are some loans that have auto renewal provisions in there, and those auto renewal provisions are typically there to serve the lender more so in an enforcement situation.
Got it.
Where maybe you had a 12% mortgage, but it auto renews at 15 with a 5% renewal fee.
So it's very important to always read all these things.
Read. And
do you hear that, consumers? You always got to read every docs.
There's a reason where, as an industry, we try to force everybody to not look at an interest rate, but your overall cost of borrowing. I've seen a lot of lenders, and all the power to them. It's not that the cost isn't there. It's some cost that they don't want to absorb. Where they'll have admin fees, they'll have review fees, inspection fees, this fees, and that builds into your front end. And then on the back end, you're coming out. There's a whole bunch of fees. So I would say if you're looking at a lender, it doesn't matter if it's A, B, C.
Doesn't matter.
Ask your broker, can you tell me what this lender looks like going in and coming out? And then add all of those costs up and look at what your actual cost of borrowing was.
That's the main thing.
When you add your fees, when you add everything, and then you look at it, it's like maybe that 599 wasn't 599, it was an 899. It just was built differently.
Yes.
Or do you sometimes get a 999 rate, and it's like, you know what? It's exactly what I said. It's what you promised me is what you delivered, and what I was promised to pay is what I ended up paying. Yeah. So again, it's a market. People are competing, and they're going to use different ways and different methods. So if you were planning to sell the property at the end of the term, maybe you don't care about the back end fee. Yeah. So, but you just want to try to keep your monthly payments low. Yeah. But at the end of the day, it's cost of borrowing.
I always say one thing, it's like how you slice the cake, right? It's the same cake, it's how you partition it. So yeah, on that note, Eric, I want to say thank you for coming in. Thank you for having me. And this was such a great conversation, a lot of takeaway. And we'll put Eric's contact in there too, Lendfinity. If you guys ever need anything, reach out to them as well.
Thank you very much. Awesome, buddy. Pleasure.